friends.
Is that us? Yes.
Oh my gosh, that is you. Like, you can see me now, can't you? I am so excited. To everybody who is watching tonight, welcome to our very first six-pack investing Q&A with my friend Pat and Erica. I will get to that in a hot second though and introduce these guys a little bit more comprehensively. But first, as always, we'd like to acknowledge and pay respect to Australia's Aboriginal and Torres Strait Islander peoples. They're the traditional custodians of the lands, the waterways and the skies all across Australia. We thank you for sharing and for caring for the land on which we are able to learn. We pay our respects to elders past and present, and we share our friendship and our kindness. So, to jump straight in, welcome Pat and Erica to your first She's on the Money webinar.
Very excited to be here. Thanks, Victoria.
I am genuinely so grateful that you guys both agreed to let me put you in front of our community to answer all the nitty-gritty questions that they've got about investing, because as much as I think I do a pretty okay job of it, like, we know you guys are arguably even better. So to do a really quick introduction, Pat is Pat Garrett, and he is the co-founder of SixPack, which, as you guys might already know, is the platform that She's on the Money has partnered with to bring financial advice to be more accessible to our She's on the Money community. I would absolutely, before I introduce Erica, I would absolutely love if you guys introduced yourselves in the comments. I love seeing where you are from and what you are up to and how you are going this evening. Like, what led you to, on a Tuesday evening or Wednesday evening? It's Wednesday, it's Tuesday, who knows, it's Tuesday. To hang out with us on a webinar. And then also we have Erica. And Erica Johnson is the head of communication, which sounds very fancy, at SixPack. And she is the one behind all of their beautiful creative and collateral, and the one that arguably, I guess, runs the show when it comes to all of the wording and all of the fun stuff. So I'm so excited to have you guys and talk about investing. I know we have a really long list of questions. I put out a type form to everybody who was attending, and we had like 2,000 responses. So there is no way we are getting through all of those questions. But the beautiful Jessica Ricci and I trolled through those yesterday, actually. And what we did was collate the most popular questions, and hopefully we can address them all. To introduce our comment section as well, hiding in the comments is Haiju and Michelle, both from SixPack. So if you have questions in there, they will be replying to you to make sure that we hopefully don't miss anything, because as you guys can probably see, that chat section moves really quickly. And unfortunately, as much as I think I'm a good reader, I absolutely can't keep up. So without further ado, we will try and get straight into the questions. But because we are responsible people, my friends, we are going to go ahead and do a general advice disclaimer first, because it would be really, really amiss of us to not do that. So before we jump into it, let's wrap the really boring but incredibly important stuff. The advice shared by She's on the Money and SixPack is general in nature and does not consider your individual circumstances. She's on the Money exists purely for educational purposes and should not be relied upon to make an investment or a financial decision. And as you probably already know, I, Victoria Devine, am an authorised representative of Australia Pacific Funds Management Proprietary Limited, ABN 341324632257, AFSL 339151. Now, Pat, Erica, thank you for putting up with that. Let's jump into the good stuff.
Hooray!
Our very first question, and I'll stop talking. So, who wants to go first? Would we like to go through it 1 to 10, or would you like to pick your favorite ones? How do you want me to do this?
Oh, you shoot however you like. It's all good.
All right, we'll just start 1 to 10. I would love to know, and so would our community. We love a lot of different investing platforms. So obviously, SixPack is an investment advice platform, whereas we also love Sharesies in our community. Pat, Erica, can we set the baseline? Firstly, what is SixPack? Let's just give you a little bit of a promo, Pat. What do you do? What do you create? But then can you tell us the difference between what SixPack is and what maybe Sharesies is, and a Raise and a Spaceship, and what makes you guys different?
Yeah, sure. Thanks, Victoria, and thanks everyone for joining. I might just give a little bit of context on the background and then let Erica address the question specifically, but I think maybe to sort of anchor what we do and our why, for me personally, Six Park is an online investment management service, as you mentioned, Victoria. And for me, the light bulb moment was sort of in 1997 when my father passed away, and I had been in New York working at JP Morgan for close to 10 years. And as a person in the financial industry, I was then responsible for managing the investments that were now for my mom. And so I went about doing that, and Dad had 5 or 6 blue chip shares in the States, and I had to figure out that was fine for Dad, what's right for my mom. And it took a lot of time. I discovered what exchange traded funds were. I discovered what I thought the risk level that my mom should take, et cetera, et cetera. And finally got a portfolio put together for her using index funds and Etfs. And one of my takeaways from that was that it was actually a lot harder than I thought it would be for somebody, particularly having been trained in this stuff. And so I figured if it's hard for me to do it, it's got to be pretty hard for a lot of people. So it's one thing to sort of get on a platform and trade. It's another to actually figure out what you should be trading and how. So the nexus behind what we've built is that there's an element of advice built into it. You use that word, Victoria, and it's an important one because what we try to do is not just give people execution, but actual investment advice and help. So that's a little bit of the background. I might let Erica touch on some of the differences between our platform and the other offerings in the market.
Yeah, thanks, Pat. I think that I've always really resonated with that story about the why we exist. And certainly from my perspective, as someone who came into investing as a complete novice, it's something that's important to me as well personally, and it's also something that is part of why we do have those differences with other platforms. So there's a lot of differences, but fundamentally you have self-directed platforms where you can make your own choices. Sharesies is an example of that. You have micro investing platforms, you have, and then you have platforms like Six Park. We try not to actually use the word platform too much because it is a service, and that sort of encompasses the fact that there is advice. So we assess your risk, appetite and profile and how long you're planning to invest, and put some guide rails around that to support the kind of investment that you'll be making. So that's part of the difference, and probably a pretty important one.
I got myself on mute because my dog Lucy wanted to join in the conversation.
Let's get Lucy involved.
Why wouldn't she?
Oh my gosh, it's her birthday, so she can get away with it. I now have a 1-year-old dog, which is very exciting for me. But I think that that's really important to point out because we do get a lot of questions because obviously at She's on the Money, we are supportive of good platforms and good systems doing great things. And, Sharesies are great people doing great things, but it is a significantly different offering to something like Six Park. Like you would go to a Six Park if you were looking for some advice, but you would go to a Sharesies. They're not going to tell you about what to invest in, but they're going to give you a really good platform if you want to go do your own thing and pick your own shares. And, you get the decision to pick what market you want to invest in. And I think that that's really empowering to be able to choose. And that's what we want to do here. We're not saying Six Park is the only one. I mean, Pat might want to say that, but we're saying it's a really good option. We really want you to throw this in the mix as something to seriously consider if you're on your investment journey and why you would do that. And I think that, obviously I am a financial advisor. I have She's on the Money, and I'm quite connected to you guys because we now have a shared, would you call it a platform together? I know you said it wasn't a platform, it's a service, but from my perspective, you guys do the service. I don't do the service. You give the advice, and we have a shared platform where I actually have guardianship over all of the clients that sign up to that platform. So I get to see it and be on the journey with them, and essentially we're kind of in business, Pat. Yeah.
I think that's the future of how people get help and get financial advice is, and this is what's new about the industry generally, is that people are getting help much earlier in their wealth creation journey. So I think the similarities between She's on the Money and the great alignment with Six Park is we're both basically helping people traverse segments of their wealth creation journey. And you do it at one stage and we do it at another, and they complement each other in a terrific way, which is why I think the partnership works so well.
Oh, that's a bit biased though, because it's you and I. But I mean, all of the people on our platform, they're really happy with it. So I think that that's a good attestament as well. Yeah. Let's jump straight into the next question. And Ruby has said, I've just got a personal message. And Ruby said, hey, can you let me know if this is recording? I have to leave. Yeah, Ruby, it will be recorded. We will upload this to YouTube so nobody misses out. But how do we start investing? Like, where should we start researching? What should we start doing? Lots of people in the comments have said, I just don't know where to begin. They end up with a little bit of analysis paralysis. There are so many options. Guys, where do we start? What should we be doing for ourselves to put ourselves in the best possible position to start our investment journey?
Well, if I can jump in on that one, because I was there not that long ago, and I certainly can relate to that. I had never actually even contemplated investing before I, got thrown in the deep end and started writing content for Six Park as a client when I had my own business, and suddenly was like writing articles about, listed investment companies and, and different kinds of investments and ETFs. And I was just like, what is all this? And, importantly, should I be doing this? And what's it all about anyway? So I can definitely relate to that. I think that everybody who's in this room tonight is already doing a great thing for themselves in terms of, what options you have available, because you're here and you're empowering yourselves with knowledge and you're starting to learn. And, I think that that's the number one thing that you can start to do is actually be aware at any stage of your life, whether you're 18, whether you're 50, that you have the potential to be an investor, you have the potential to be growing your wealth. So from my perspective, then it's, one of the most important things is starting to understand your own appetite for risk and what you want to be doing. Because, some people love researching stocks and ETFs and starting to work it out and managing those things themselves. I know a lot of people who love that and really enjoy it, but a lot of people don't. And that's when a lot of the time that sort of analysis paralysis kicks in is, I don't know what to choose. I don't know how much to invest. I don't know any of that. What do I do? And I think that that's where something like Six Park or Raise or, other platforms can really be a great starting point, particularly as a way of just starting small. I started with Raise, and it was a great way to just start understanding how things go up and down and those kinds of things. So, starting small and starting to learn is a great way of doing things. And a lot of our clients have, do that. They start with a Raise or Spaceship or, other micro investing style platforms. And then sort of as they become more confident with what they're doing, then they move into something else or keep doing both,
I couldn't agree more. I think also remembering that it's not just about the platform that you pick, but rather what your goals are and what your values look like and what your personal situation is. Because I think that, She's on the Money is a community of really intelligent people wanting to put themselves in the best possible position. However, some of you might be in debt, and then you might also be putting pressure on yourself to start investing when the best investment for you might be paying off your personal credit card or paying off a personal loan or focusing on saving for a baby that you're having in 6 months. So not everybody is ready to start investing, if I'm being honest, and that's not what you want me to say, but we need to be in a position where that's actually a sustainable decision for ourselves, and we're actually being kind to ourselves on that. I know so many of you listen to our podcasts or, listen to a webinar with Pat Garrett, and you're like, oh, that's exactly what I need to do. When in reality, we actually need to make sure that we are looking after ourselves first. So I would be making sure I'm out of personal debt. I would be making sure that I have an emergency fund and I do have the free cash flow available to allocate towards an investment. And then I'd be thinking, okay, what do I actually care about? Am I an ethical investor? Do I want to manage this myself? Do I not want to manage this myself? What does that look like? And then find a solution that works for what you want, not necessarily go, well, she's on the money community, obsessed with Six Park, and actually picking that just because you think that that's the right answer. But obviously, like, we think it's a good solution, but it's one of the things that I actually want you to put yourself in a position where you're like, do I want someone to help me on that journey? Do I want investment advice? The answer is yes. Fantastic. Make a consideration. Work out what you want. If you're like, no, I want to buy my own stocks, go find a platform that enables you to do that. So, yeah, sorry to add that, but I think it's really, really important. So, next question, my friends, and I think this one is for you, Pat. What do you think about SMSFs? And should we start with what an SMSF is?
Sure. A self-managed super fund is an SMSF, and there's a notorious trick of trying to get that right, not say SMFs.
I mumble it all the time.
Yeah.
ETF, I always say EFT. Like, that's just not on at my level.
Self-managed super funds are actually sort of legal structures in which you can effectively take your super out of the regulated super funds and manage your superannuation assets yourself. It is a very good option for those that have the time and attention and desire to look after their own investments themselves, and they are your superannuation assets. So you do have to be very careful and have a good plan. You're actually mandated to have a good plan with how you invest those funds. But if you're not happy with how your superannuation fund is managing your assets, you can open a self-managed super fund and by definition manage it yourself. It does come with a variety of legal obligations because the government doesn't want to let people take their superannuation and go do whatever they want with it. So the pros are it gives you control of investing your super assets. The cons are it does take time and cost some money, and you need on an annual basis to continually review how it's performing.
I also think it's worthwhile thinking about how many funds you actually have in that. Because if you're like, oh my gosh, I hate paying superannuation fees, one thing that you need to consider is that, yes, you might be saving money on super fees because you're not paying it to an Oz Super or a Host Plus, but you're going to have a lot of compliance fees on the other side and accounting fees. Because in addition to having a self-managed super fund, you're now needing to do a full self-managed super fund tax refund every single year. And if you're not up for that, that is a very lengthy process and it can actually be quite expensive. I've seen them be like $6,000-$7,000 because of the audit that is necessary on top of the accounting side of things. And I think that a lot of people are comparing apples with apples. Like, what is a fee for a self-managed super fund? And you're like, well, here's this, and it's much cheaper, but you're not taking into consideration all of the collateral that you might have to spend in addition. So for me, that would be something that I think is really worthy of consideration as well.
It's a huge consideration, Victoria. It's a good call out because very simple self-managed super funds have a certain price point of administration and an audit. More complex ones, that price can go up quite quickly. So you do need to do your homework on whether you're actually paying more in a self-managed super fund than you are in your regular super fund.
Yeah, and that's very likely and goes back to, like, if you don't have heaps in your account, like, it's probably not an option that is super viable unless you're working with a financial planner who's made a super watertight plan for you that makes a lot of sense. It's not something I would actively recommend. Just go and set up yourself. It's quite risky.
The ATO has guidance that you need something like $500,000 to have a viable SMSF. We actually think it's closer to, half of that. But once you get much smaller than that, to your point, Victoria, it costs a few $1,000s to administer, and that just becomes a high percentage of a smaller number. So it's not something for small balance accounts.
Yeah, absolutely. Fees are super important to take into consideration, which is actually the question I am leading into. Erica, I think I'm going to throw this one directly at you.
Sure.
And the question is, when investing by buying shares, there's a brokerage fee, obviously. Is it better to invest large sums of money, for example, $1,000 at a time, each time, or stick to investing your whatever you can afford each month, whether that's $100 or $500? Like, why might we consider a bigger lump sum investment at less regular intervals when it comes to brokerage?
Well, probably one of the things to consider there is what the brokerage fee actually is and how many, like if you're only having to invest, if you're investing the whole sum into one ETF, for example, then you're going to pay one brokerage fee. So it might be worth doing multiple times to get it into the market more frequently. But if you're, investing across a diversified platform and there's a lot of different charges involved, then you might want to not do that quite so frequently. So it's kind of another version of, well, what's the fee that you're paying? There's huge variations in the cost of brokerage for people who are looking after that kind of thing themselves. So it's worth shopping around and knowing, if you know what you want to buy, then, make sure that you're on the best deal. So look into that. But dollar cost averaging is, typically considered a really smart way of keeping your investments ticking over. So the idea of dollar cost averaging is that you invest what you can afford to invest comfortably, and you do that at regular intervals. You don't look at whether the market's up or whether it's down. You just say, right, it might align with your pay, for example. You might say, I can invest, $500 a month. And you deduct that, you put it straight away and you get it invested regardless of whether the markets look to be going up or down. You just say, I'm committed to doing this at regular times. And the idea is that over time, whether the market is up or down, you're going to harness the benefits of being invested, and you're going to do it in a way that continues to grow your investment and the compounding impact of having that money in the market.
Yeah, I couldn't agree more. And there's some recent research that has actually come out saying that if you missed out on the 10 best days in the share market over a period of 30 years, you are missing out on, I think it's like 60% of the growth of your portfolio, which is crazy. And unfortunately, as much as I think that Pat is one of the smartest people I've ever met, he's not that smart. He can't time the market. Literally nobody can. So the second best thing that we can actually do, instead of trying to time the market and think that we're all geniuses, which is not possible, is dollar cost average into the market so that we just make sure we never miss out. If you never miss out, you're always getting the gains, but it means you can ride the wave. And when it goes down, that's okay too, because that's part of the journey. Yeah. And I think it's important to point that out, because I think a lot of people ask the question of like, when's the best time to invest? And this one isn't one I've prepared you guys for, but like, what is the best time to invest? When should we be doing that, guys?
I think if you've got funds to get into the market, the best time to invest, you'll hear some people say, was yesterday, but the best time to invest is now. If you've got a medium to long-term time horizon, there's a lot of data to suggest that trying to figure out exactly when to time getting those funds into the market is a pretty futile game. It's just too hard. And so being on the sidelines and waiting for when the right time to get into the market is sort of a proven strategy to underperform. So if you've got funds to invest, it's best to typically it's just best to get invested. And if you have the luxury of being able to add periodic funds over time, to Erica's point and your point, Victoria, on dollar cost averaging, what history does show is that, for example, the Australian share market has averaged returns of about 8 or 9% over a 10-year period. Every 3 to 4 years is a down year. So by investing periodically over the time, you're actually investing during the peaks and the troughs as well, and you're reinvesting dividends during that time. So there's my point is there's a big opportunity cost by sitting on the sidelines, because you're not getting the benefit of dividends and reinvestment. So a lot of people have lost money trying to wait for the perfect time, and there really is no perfect time.
The other thing, if I can jump in, that feels important to point out when you're talking about getting in at the right time is that the other thing that a lot of people try and do is get out at the right time. And again, there's not an easy or good way to do that. I wrote a piece earlier this year comparing some different scenarios about people who started investing at the start of last year, figuratively, and then the COVID crash happened, and what would have happened in 3 different scenarios. So if you sold down and then just stayed in cash, if you sold down and then bought back in when the market started to recover, or if you just absolutely sat still and did nothing and just rode it and just went, oh my God, just forget about the red, just hang in there. And what we found was that as of the end of September, there's a 30% difference between the best and worst outcome. And the best outcome was with the person who just did nothing, who just stayed where they were. So, getting out at the, thinking that you know when to get out and back in is also, fraught with danger. And the behavioral kind of economists will just say, there's no perfect time to get in or out. You just stick with your strategy and go from there.
Yeah, and I think that that's really important to take into consideration. And when we talk dollar cost averaging, we're not saying get into the market every single day. We're saying get into the market at least every season to make sure that you aren't just picking like 1 month every year. And I know that, I can see it in the comments at the moment, and I've had this question before, like how regularly do they do it? Do they do it every time they fund my account? Like if I'm with SixPack, does that mean that they'll, invest on my behalf if I hand over my money to them today? The answer is no, because it's actually in your best possible interest to make sure that it is considered and well timed, and we are in a position where we are making sure that you have enough money to invest to minimize brokerage fees. And is there anything else you guys want to add to that? Because I've answered that question so many times, and to me, what you've done makes so much sense. But when we say dollar cost averaging, you're like, well, does that mean every day? What does that mean, Pat?
Yeah, I've seen a couple of comments, Victoria, in the comment section about if I've just inherited, $100,000, should I put it all in now, or should I put a little in now and a little bit later? And I'd be remiss if I didn't say it depends a little bit on your situation. Like if you might need half of that money in 1 year, and you really don't want to risk the possible reduction in the value of that cash, you might stage it over time. So it depends on your situation and your goals. But there is typically not a benefit by trying to say, well, I'll put some in now because I'll figure out when it's cheaper markets later. That's a roll of the dice as to what the markets are going to do, and speaks to the sort of the behavioral dimension of investing. Investing is probably 10% brains and 90% emotional response to when things go wrong. Victoria, to your point earlier about how to get started, I think you touched on all the right things. Get out of debt, start your budgeting process, et cetera, et cetera. Those are all prerequisites to getting invested. If there was one thing in my sort of career in the industry I would try to boil down, is that the industry has overcomplicated itself to a lot of extent, and it actually tries to almost be so confusing.
That sounds smarter, Pat. Like if we use really long words and also acronyms that make no sense, I can charge you massive fees.
That's exactly right. If you're so confusing that your client doesn't know whether you're adding value or not, you just hand them the money and say, I hope they are. That's not the way this industry should work. And what I would counsel people is, after those fundamental kind of building blocks that you refer to feel comfortable and stable, formulate a plan, keep it simple, be patient. When your emotions start to get the better of you about maybe deviating from the plan, step back. You have control over those decisions, and emotionally based investment decisions are generally not good ones. So I think that kind of speaks to this concept of there's so much noise in the market right now about commentaries I can imagine a lot of people on this webinar right now are really like it's a stressful time to be thinking about when to get to invest, but it's a good time to have a step back and try to just keep it simple and stick with the basics.
Agreed. And speaking of the basics, I know you, Pat, and SixPath believe super strongly in the benefits of low-cost passive investments like ETFs. And we just talked about how it's really hard to time the market. And in the same way, it's really hard to pick winners. And I think it's really important to understand that there's a whole team behind SixPath. It's not just Pat saying invest with us or this is what we do. It's a whole team picking things in the background and making sure that they are the right investments for your clients. So can you tell me, what are the top 5 things to look for when you are choosing a stock or ETF? And maybe if somebody in our community is planning on just doing it themselves and not going through SixPath, what should they be looking for? How should that work?
Sure, I'll have a crack at that one.
We've got 5, all right? I'll count you down. Keeping track.
Don't hold me to 5. I may end up having to come up with some names.
Sorry. Just be like, oh, pick the red one. Goes faster.
I'll start with stocks because the answer for stocks and the answer for ETFs is actually quite different. On the stock front, to try to keep it relatively straightforward, you want to do your research on an industry or a sector, and form a view as to why you think that industry or sector might do well. You then will likely then narrow down a field of companies that you think should do well over the long term in that sector. And then basically try to consider building a story around, I think this company is going to do well relative to the competition because of XYZ. Now, if you're into things like price earnings ratios and other technical things, you then have a look at those and do some research. Or you might go with gut feel and back the company because you use the product and you love it. But some basic due diligence about the health of the company, whether it's earnings or sales. You can go on the internet and learn a lot about specific companies that'll give you an indication of whether you feel like they're traveling well or not. And you want to hold on. Warren Buffett had a great saying. He said, if you're not willing to hold a company stock for 10 years, don't hold it for 10 minutes. So just do your homework and convince yourself that you're happy to hold it for a while and you think it's got staying power. On the ETF front, it's a little bit different in that ETFs, as you know, are ASX listed index funds that hold a basket of securities, and they track an index. The original index funds were fairly straightforward. They tracked indexes like the ASX 200, which is a fairly easy index to understand. The S&P 500, which is a fairly easy US-based index to understand. And big providers like Vanguard and BlackRock, who have massive track records in doing this stuff. So the first thing I would say you do on the exchange traded fund is check the issuer, check the track record, look at the index and the asset class that the ETF is. It could be bonds, it could be property, it could be infrastructure, it could be China technology, all sorts of things. Look at the index and read the very simple information that will be online about it. And it should be really transparent what it does. And if it's not transparent, big red flag number 1. Look at the costs. There's a great ASX fund report that shows you all the costs of them. If they're more than 0.5% management fee, that starts to get kind of high for an exchange traded fund. Look at their track record and size in the market, and that's really it. They have fact sheets that tell you a lot about what they do and what their index tracks and how long they've been in the market doing this. And so it's a slightly different approach. The last thing I would probably say is just to sort of illuminate the point a little bit. You can buy a State Street's or Vanguard's international shares ETF, and it's really transparent that it's 1,500 global U.S. technology. But there's ones coming out now that are like esports or lithium battery or certain types of biotech. When you start to get into those type, then they're much more narrowly focused and a little bit less transparent. And just know that whilst you might be attracted to the strategy or the thesis. You just need to do a little bit more homework on them because they're a little bit more specialized.
I have a couple of favorite failed ETFs from the United States, where the ETF market has been, is a bit more mature than ours. We're only 20 years old here, but a couple of favorites were a fishing ETF that tracked fishing supplies, and a wound care ETF that was, and in fact, like there's probably like a huge industry of like wound care products, but whether or not we need an index that tracks them, the ETF's failure suggests that maybe that's a little too specific.
Yeah. And I'll add one closing thought that's timely. What people were probably reading a lot about is the concept of rebound stocks. So what stocks will benefit from a rebound out of the pandemic? Now that's a good theme, but guess what? Every other investor in the market's thinking the same thing. So what could be happening? Prices are going up for the companies in that sector. So a good idea on paper, you just need to do your homework a bit because the product issuers are in the business of selling their funds to you. So just always keep that in mind.
Yeah, and I think that that's the beautiful thing about ETFs, right? Like the purpose is with an ETF, there will be a fund manager that manages that portfolio. And you can actually look at who they are and what their values are and what they might be picking and why. And that's something that I love looking at. I mean, there's a couple of fund managers that I've been chasing around from ETF to ETF in different businesses, and they might have gone from BlackRock to Vanguard, and I liked what they did at BlackRock, but I know they've moved to Vanguard, and so I'm interested to see what changes they might make there. But not everybody is as into that as I am. But I think the beautiful thing about ETFs is that there's an ETF for everything. Like on the ASX today, there are more than 200 different ETFs for you to choose from. And this just means you get automatic diversification by picking that as opposed to a straight stock. And, as you're saying, there's phishing ones. I know that you can, especially in America, look for all women leadership boards if that's what you're into, or you could look for a sustainable option and see what is there. And I mean, when we compare it back to Six Park, obviously Six Park has done their due diligence and creative portfolios that have these assets in them, because it is a hard decision. It is hard to do that. And once you've chosen as well, it's then on you to make sure that you're still happy with the performance. You're happy to make sure that you're holding the right amount of it. You're rebalancing it consistently for yourself and making sure that you're holding enough of each thing and working out what that looks like. We're not talking performance here. We're talking about asset allocation. And that's harder done than it is said. Like asset allocation, you're like, cool, I'll just divide it into a pie chart, right? That's fancy. Whereas that's not what happens. So Pat, I know that this is, maybe not what we're meant to be talking about, but I'd love you to explain a little bit more about how that works internally with you guys and what does that process look like? Like, I know that you guys have picked some really solid options for Six Park, but just because you've picked them doesn't mean you're married to them for life. You might make a decision to go, you know what? The best thing for our clients is to switch, and this is why. So how do you make those decisions?
Yeah, we're actually getting ready to make some changes into some ETFs that we think are improvements over the ones we originally had for a couple of the portfolios. But fundamentally, Victoria, our investment committee is mandated with a variety of things, but the two main ones are to assess what the best ETFs in the market are to use to get exposure to different asset classes that comprise our portfolio. And we use the same criteria that I mentioned before. Are they large? Are they liquid? Are they credible? Do they have a good track record? Do they do what they say they're going to do? And are they cost effective? So ETF selection is one. The other, which you referred to, which sounds sort of technical, but asset allocation is arguably one of the most important decisions any investor will make. Asset allocation in sort of plain terms is how you spread your assets across different either growth-oriented assets or defensive-oriented assets. So higher risk, higher reward potential, lower risk, lower reward potential, like bonds. How do you weigh up how much to have in in the growth versus the defensive. That's the fundamental aspect of asset allocation. And there's studies that show that around 90% of a long-term portfolio's return will be driven by asset allocation decisions as opposed to stock selection decisions.
Which, that feels like a lot of pressure, Pat. I don't like that.
Well, we have some really good
sometimes, and I'm like, oh, that's nice. And then you're telling me it's actually about what I choose, not what they're performing. Why?
Well, it's a combination of the two. You don't want to get in theory, your asset allocation right, but have dud funds representing the asset classes. So, for example, we have State Street for ASX equities. We have Vanguard for international shares. We have Van Eck for global property. We have, we spread it around and try to get the best ETF endpoints for the asset classes. But what a lot of investors, I think, and it's understandable, right? When you think of investing, you think, oh, I'm getting into shares, primarily Australian shares, but it's a lot more to it. There's bonds, there's infrastructure, there's emerging markets. It's the combination of those in your portfolio and what's dialed up and what's dialed down. That's actually how you manage your investment risk. That I'll sort of stop there because that starts to get into sort of technical. That's what our investment committee does. That's what I had to do for my mom. I had to figure out when my dad's portfolio, which was right for him, it wasn't right for my mom because all of a sudden that was how she was going to pay her bills. So I had to figure out how do I get her not only the right ETFs, but how much in bonds. Dad didn't have any bonds. He had all shares. It was all about growth. So that asset allocation is incredibly important. Thankfully, we've got an incredibly good investment committee that does that for us. They're experienced at asset allocation as well as investment management. So what we try to do is take, and my learning from that experience years ago was, if we can build a service that does that part of the heavy lifting, then we've done something good for investors.
And I think it's really cool to deep dive and be like, how do you do that? What do you do? And I mean, that's what I get to do and what I have done to you guys for literally more than the last year to work out whether I should partner with you or not. Like, I literally was like, what's that mean? How's that work? And I think you guys were like, oh my gosh, she's full of questions. Why? But for me,
we love questions.
Love questions, but like, I don't know if you got sick of them. And if you didn't, I'm really grateful for you. But I think it's one of those things that we just need to talk more about, like what asset allocation means, because it means something different to everybody. Like, at the same time as us going, cool, Six Park is a platform a service that you can jump on and you can get advice from. They're going to pick that related to your goals and your investment risk profile. It's not just going on and going, okay, cool, like it'll be the same for everybody. No, if you're conservative as an investor, that's going to be a very different platform or very different portfolio than a high growth investor. And like, I know that these things are different, but they're also so important, like your investment risk. And I can see some questions in the She's on the Money, like the group chat just here, where people are like, oh, what about crypto? Or what does this mean? And these aren't things that personally I'm willing to invest in because they just have too much risk. They are just genuinely, and there's a multitude of other reasons I wouldn't invest in them, but they're an asset class that I just don't see as something that has the sustainable future that an asset or a well-diversified portfolio with ETFs and well-balanced assets makes sense. I mean, I can understand why people want to pick it up and have a play with it and dabble in it, but I certainly wouldn't be personally putting my life savings into something that is so new and carries so much risk, because the whole point of investing, and I think that this plays into what I do as a financial advisor. Like, I can distill my job down so boringly. It's so cool. My job is to get you to a safe and comfortable retirement. That's it. That is my job. And that is, on paper, incredibly boring, but it's all the nitty gritty in between that. What do you want to do? Are you planning on getting married? Are you having kids? Are you not? Are they going to private school? Are they going to public school? Like, what decisions and lifestyle do you want to have? Are you going to be like retiring on a yacht in the Bahamas, or are we just going to get a caravan and go around Australia and live our best lives? Like, what does that mean? What are we working towards? And there's a different portfolio and a different strategy for every single person making every single decision. So I think it's really important to remember that there's no one size fits all solution. There's no platform that is perfect for everybody. There is no platform or service or, anything that is going to be the be all end all. Like, I can't turn around and be like, oh my gosh, SixPark's perfect for everybody. Because as much as I adore it as an investment platform, if you said, Victoria, I really want my insurances done, I would really love you to sit me down and tell me how to save better, SixPark can't help you with that. And we're very clear about where you guys shine and where you don't do, because if we just we're everything to everybody, we're going to end up in a whole heap of trouble, my friends.
Yeah. And I think you touched on a good point, Victoria, in terms of what we've seen a lot of is people come to us with questions about crypto, or can I pick the exchange traded funds because I've got a view on something, or I've seen something that I like. And we have a lot of clients that use SixPark as like a hub with spoke investments or a core and a satellite, where they feel a measure of sort of safety or stability, as the case may be, in having a boring but beautiful portfolio of the diversified ETFs.
I invest on SixPark. As you guys know, I have money on there, and I have a few platforms because I'm loyal to nobody.
Yeah. And if you want to do things like crypto around the edges, I would suggest you probably sleep a little better at night if you've got that. If it's just another measure of diversification.
And that, my friends, is called what in the industry we would say is a core satellite approach, right? So we'd have our core portfolio, and that's the trusty steed that we know is going to get us to that safe and comfortable retirement. And then you'll often see people having a bit of a play around the edges. You might say, oh, Victoria, I know that you said you don't love crypto, but I really want to put some money into it because I want to watch it and I just don't want to miss out. And you go, okay, well, why don't you put a couple of $100 into that is non-coincidental to you, that you can have your fun and actually play around with different assets. And I guess that's the beauty of SixPark. That could potentially be the platform that you get the advice from, or you might have a financial advisor in that place or a different service offering. But it's one of those things that you also look at and go, you can be on Sharesies at the same time. Maybe you want that core approach and you also want to go on Sharesies and pick your favorite stocks. And you heard that Facebook was a good asset to pick, so I'm going to go buy some of that. And also everybody's talking about Amazon at the moment, so I want to do that. Tesla, oh my gosh, like that's where you can have your fun and actually do that, because they're going to enable you to do that as well. So I think it's important to remember that, we're not everything to everybody, but we do a damn good job.
Well, we have a lot of, I've done a lot of stories with clients who work in financial services, Victoria, and who are just like, look, I work in this all day, but I don't want to do it in my spare time. And fundamentally, the people who are making decisions for your clients are the people who I want making decisions for me. And that's a pretty powerful message that comes through really strongly.
Literally that. I am a financial advisor. I have a financial advisor. I do not make decisions for myself. And the reason I don't do that is, as much as I know that I know what I'm talking about, my clients trust me, emotional behavior takes over. Like, I need someone to sit me down and be like, Victoria, you're spending? Nah. Like, I see that the Iconic has featured in your spending a lot this week because they had a really good saving, rein it in. I want that level of accountability. I want someone to take it and always be putting my best foot forward, because they always say the plumber has the leaky tap. Like, I wouldn't prioritize myself and do the right thing. So I think that it's actually not that uncommon for financial advisors to also have financial advisors and trust platforms and trust, the professionals in the space. Because if I didn't, wouldn't you be concerned?
Yeah.
So I feel like we are flying through these questions and we don't have heaps of time left. We have 10 minutes left. So I'm going to try and squeeze out every ounce of value from you two as possible. So the next is, Pat, this is a question I get all the time, tax. If I'm going to start investing, do I have to tell an accountant? Is it going to make tax time really complicated? What do I do?
Yeah. Generally speaking, when you buy a share or an ETF, you don't need to tell your accountant when you buy it. But as soon as you buy it, if it pays a dividend, you're going to start generating income on that investment. That income, for the most part, and first of all, let me preface all this with talk to your accountant about this. But so generally speaking, the dividends will be taxable income to some extent. When you sell that investment, you will either have a gain or a loss, and that will be the time that you have to report that gain or loss. If it's a gain, you're going to probably have to pay some taxes on it. If it's a loss, you'll be able to prospectively use those losses to offset gains on other investments. So when you buy something, you don't necessarily need to tell your accountant. But when it comes tax time, you need to let them know about any income you've received or if you've sold shares.
That sounds really confusing. I'm not going to lie. Can I go onto like a portal? Can I log into SixPark and get a report that I hand to my accountant? Is that a thing? Because like I don't want to have to go in and calculate my gain and then what it means for tax. Like, maybe I won't invest if that's the case.
We generate a consolidated tax report every year, Victoria, and it pulls together all of the holdings for your portfolio, so that you can just. It's literally a fill in this number in this part of your tax return. So whether you're doing it yourself or whether you hand that statement to your accountant, we aim to make it really easy. I can absolutely tell you that is not something that just happens behind the scenes.
No, it's actually quite complex. As a financial advisor with a portfolio of clients, debt cross reporting time is not my favorite.
Yeah, and we have a very, very thorough chief financial officer who literally makes us get it right down to like the 10th of a cent before she will say, yes, that data is correct.
I love her.
And oh my God, the building of this tax statement, sort of tech and infrastructure behind the scenes, was absolutely amazing. It was a huge exercise, but it means that things look really easy for you guys when we produce that statement. So.
Yeah, and I probably sounded a little bit silly when I'm like, oh, is that a thing? I knew the answer to that, but I wanted to make sure that we spoke about that because that's something where often if you're doing your own investing, you're going to have to pull that together yourself. And I know a lot of people will say, oh my gosh, but it's so much cheaper to just jump on and buy this ETF directly. Like that's then your responsibility. Whereas what you're saying is you're taking responsibility for that. And that's part of the service that you provide to your clients, because it's not just users of a platform. They are legitimate clients. And even if I've got a question, I can call you guys as well, right?
Yeah. And, my accountant, for example, I remember the first time that I said, I bought some ETFs this year. And he was like, like, how many?
Like, thanks, Erica.
And I was like, no, it's okay. I've got a statement. And he generally charges more for people with ETF holdings because he said it can be a real nightmare because there's a lot of them. There's a lot of work involved. But yeah, so we aim to make that pretty straightforward.
One of the questions that just came through is are the tax dimensions different for international based ETFs? And the answer is yes, because some of the income is sourced overseas, but it's all kind of put onto one page into certain buckets. And what we do is consolidate those across the international holdings. So it's all on one page that an accountant appreciates in that format, as Erica mentioned.
They love it. I'm telling you right now, it makes it so much easier. I mean, I'm glad that you guys are doing the hard yards, but it means that tax time is not going to be more complicated for you. And I mean, at the end of the day, not that you guys are going to like this. If you're super stumped, you can always call SixPark and be like, where do I put it? How does it work? And you guys will be like, all right, there's been a couple of you. We actually wrote an entire blog. This is where. So I feel like that's where you guys shine and you're really responsive as well. And, we're wrapping up now and I've probably got time for 2 quick more questions. But if you guys have questions and want to learn more, the SixPark blog has been a very valuable resource for our community to find out what's going on. At the end of the day, Erica is a pretty talented writer and a lot of her content is sitting there that it's Pat approved. And it's sitting there and it's ready for you guys to read. And if Haiju or Michelle are so kind, you could put a link in the chat so everybody can follow that up after this webinar. as I said, I don't think I have heaps of time left, and we've spoken about so much stuff tonight. But we mentioned before, and I think I saw it come into the chat just before, about dividend reinvestment. So someone asked, how do you make sure that your dividends go back into your reinvestment? Like, what if they're paid into my bank account? Like, how do I make sure that I'm actually making compound interest work as hard for me as I do for it?
Yeah, so if you're setting up an account with Six Park, we have different share registries who will send you paperwork, and we give you a guide on how to complete that if you want dividend reinvestment or if you want electronic communication. We strongly recommend electronic communication to save trees and save your mailbox, and save Australia Post from having to, be any slower. Sorry, I know they're doing their best. But with dividend reinvestment, it's simply a case of going on once and setting that up with each of the registries. And what that means is that any dividends that are paid by the ETFs that you're now invested in, when they get to the amount, when there's enough of those dividends to buy more units of that, then they are automatically reinvested, and there's no brokerage costs. It doesn't count as, it doesn't need to happen. You don't need to do anything. If you don't do that, then the dividends get paid back into your Macquarie account. Over time, they'll accrue and they'll add up to your balance, and then they'll eventually be reinvested unless you tell us not to. So it's a different, either way, you'll probably end up with them invested, but dividend reinvestment plan just makes it happen faster.
But on the flip side, if you didn't want them reinvested, like you got further down the track and you wanted to start taking an income from your investment portfolio, which, if we cut to the chase, at the end of the day, we want to be in a position where we have this epic investment portfolio that then provides us with a passive income. That means that we get complete financial freedom. Like, you don't have to show up to a job, a place, a location, or even a relationship that you don't want to go to, because you've got an income coming in the background. You guys can make sure that happens. You just tick a different box and it'll be put in your bank account for you to spend when you get to that point. But that's what we're working towards, right? We're not here going, okay, cool, in a year I'll have this passive income. It could take 20, 30 years. And that's where you have to remember the long slog. We have to remember that over the long term, this is what we are working towards, and good investment. It's boring, as our friend, what's his name? Where is my brain gone?
Warren Buffett?
Yeah, him. I've heard of him. Warren Buffett says that compound interest is the eighth wonder of the world, and he also says that good investment is boring, and he couldn't be wrong. Like, that is so true. If you are up at night and stressed about your investment and you're worried about it consistently and you're checking it literally every day, I would really urge you to reconsider what you're investing in, because it doesn't sound like it's good for your mental health or good for the long term, because you're very likely to run away from that investment and exit that at a time that is not very good for you. So I think it's important to remember good advice, especially good investment advice, is worth its weight in gold, because they're there to actually help you through that. And I mean, at the end of the day, if the market's going down, I'm a financial advisor. I still feel that little pit in the bottom of my stomach. Like, and I'm sure you do too, Pat, when you're like, I hate that. Doesn't go away. But we have the strategy to deal with it.
Nobody likes to see an account value go down. I've seen a couple of questions that speak to your a part of what you were touching on, Victoria, and that clients are able to retake, and I would suggest if they don't do it via Six Park, they do it themselves. People's circumstances change, so you can imagine at the beginning of COVID, if people lost jobs and income, their risk profile changed. I just would note that clients are able to retake the assessment if their circumstances change at any time, because that's actually what happens. People
always.
And if the recommendation is different, you can tweak up or down sort of the amount of level of risk you're taking based on how you answer those questions. So I saw a few questions on that front. Can we take the assessment after the first go? Absolutely. Also a question about, are we able to log in? A couple questions about, are we able to log in and see our holdings? Absolutely. paramount to what we do is that you have transparency in the holdings you have and how they're performing. So to the few that have asked about logging in, absolutely.
Yeah. And we have run out of time. So are there any wise words that the two of you would like to leave us with? I feel like this is potentially not our last webinar. If you guys are keen on another webinar, please let us know in the comments. But Pat, Erica, is there anything, any wise parting words you'd like to leave us with this evening?
Oh, putting the pressure on, Victoria.
No pressure, no pressure.
Look, I just think that like it's a privilege to be here tonight. It's a privilege for us to manage people's money. That's something that I learned from Pat, from our investment committee, that it's something really important. So, you know, to everyone who chooses us, whether it's tonight or in the future or has already chosen us, thank you. I think everyone who is part of this community is doing their best to learn. And ultimately, you know, as someone who started with very little knowledge, I just think absorb all of the knowledge that you can, keep doing what you're doing, and don't wait for perfect. A friend of mine once told me that perfect is the enemy of done. Yeah. And when you don't get in, then you're sitting on the sidelines. So, yeah.
Pat, are you going to try and even follow that?
So I'm going to go with ditto plus one thing, which is in your and speaking to the audience, in your journeys of exploring financial wellness and learnings, I would just encourage you to do a little bit of work on what you've heard a bit about today, which is behavioral economics, behavioral finance. If you Google it, you'll see exactly what it means. It is almost as valuable as anything you'll read to understand how emotions drive your investment behavior. And if you can recognize that, that will hold you in very good stead, because markets go up, markets go down, and that's an important aspect as well. Other than that, Erica summarized it beautifully. That's why she writes all the stuff.
Yeah, that's why she does all the content. I think you're actually the genius, because I'm going to get Erica. She is going to make us shine. All right. So I do think that is all we have time for this evening. I would like to thank you both for joining us. But before we run away, I would never announce a competition at the start, because I only want the OG people who have actually stuck it out to be able to enter. So I actually have 2 books here. I have 2 signed copies, one of She's on the Money and one of Glenn James's Sort Your Money Out from our friends at My Millennial Money. And I also have a budget and cash flow masterclass, because as you guys know, I have my budget and cash flow masterclass. I have a login to that for one lucky person. And to be able to win that, I would like you to share on social media where you are watching from and tag She's on the Money. And I will pick the winner tomorrow, because I want to see all your lounge rooms, because we aren't able to actually meet in person. So thank you guys. It has been an absolute pleasure having both of you. I am so grateful to be in your lives and in your realms and be able to share you with our beautiful community. I know that they are probably incredibly grateful, but this isn't the last you'll see of us, I don't think, friends.
Oh, I hope not.
Thank you, Victoria. You bring great energy to this discussion, so I appreciate that.
I love that. Thank you so much.
And we'll do our best to follow up with any of the questions that we haven't gotten around to. We can try and pull some of that together and share it back with everyone who's registered in the coming days.
Yeah, I've got a couple of questions here just to clear that up. Yes, it is on Instagram. Pop it on your Instagram stories and share it. If you aren't on Instagram or social media, that is okay. Shoot me an email to hello@shesonthemoney.com.au and I will throw that into the entry and make sure that nobody misses out. So enjoy the rest of the evening, guys. I'm sure I will see you all very soon.
Thanks so much.
Bye.
Bye.